great future. We're talking real money.
Well, if it's Friday, it must be question and answer day. However, because you have not lived up to your responsibility and called in enough questions, I blame all of you for not calling in enough questions. For some reason, you enjoy typing them. Is it really easier to type that? Are you all really that good at typing that it's easier for you to type a question than to speak it into your mic? Come on. I'd rather dictate any day. I hate typing, but apparently you love typing. So for that reason, we don't have any of your calls because I think only 2 of you spoke in questions in the past week, and I need 4 to do a Q&A episode. So that forced me to once again do another podcast with Tom because he keeps all the typed questions.
I could have something,
It's true. He does. He hoards them. He's got this little. He's got
laid
this
out
box.
all over my office.
Yeah, he's got this little box on his desk with a little lock on it. And he goes, "Don't touch that. Those are my magical questions. Don't mess with my magic questions."
Well, if it'd be better, would you like me to read them in as I think these people probably sound?
I was hoping you would do that. Actually, I was gonna try to get you to give me the questions because I do voices.
I know. I only do about 3. I could do Clinton.
Yeah.
I could do Clinton for you if you want me to do Bill Clinton.
Do you think any of them sound like Bill Clinton? Really? Do you have one from Arkansas? If you have one in there from Arkansas, you can do your Clinton.
See. Okay.
If you don't know, you can't do it.
There's Mechanicsburg, Pennsylvania.
Nope.
Sterling Heights, Michigan.
Nope.
Smyrna, Georgia.
You don't do a good Georgia.
No, I don't do.
Georgia's a little bit thicker
Olympia,
than
Washington, and St. Louis, Missouri.
Yeah, all pretty much Midwestern.
I can
except
do
for
a
Georgia.
Nixon. That's California.
Let's not. No. Let's not.
Let's make one thing.
No.
Clear,
Bad.
Don.
I mean, come on.
Okay.
If things aren't bad enough now, you're going to throw that one into the mix.
I see. Just when you
Think about it for a minute.
Okay. Fair enough. Indeed.
So Tom is going to ask questions that you sent in via your type-in little digits at talkingrealmoney.com on the contact form.
All right.
Silly
This comes
people.
from Mitch in Decatur, Indiana.
Hello, Don and Tom.
Oh, stop it.
Sorry.
That was just
Sorry,
mean.
Mitch. That's just not nice.
No.
First of all, I want to thank you for all the wonderful jokes
is he, a minion?
that Tom supplies on the show.
He
I
says
added
that?
No, he doesn't say that. I just put that in.
See, and this is the thing. I can't see the darn questions, so I don't know if he's lying.
All right.
I'm just going to assume he is lying.
The rest of this is verbatim. And if
Okay.
you can spell that, then you're
Sure.
better than I am. All right, here we go. What Vanguard funds can be used to closely replicate AVGE, which is the Avantis Global Equity Fund? I've used VT, VTI, and VBR to get a similar market cap makeup to AVG, but it seems redundant. I don't want quite the 60-40 U.S. to international split that VT provides, so I weight my portfolio a bit heavier towards U.S. stocks with VTI and VBR. These are all Vanguard index funds, by the way. I shoot for 60% U.S. large cap, 25% small cap, and 15% international. I like the lower expense ratio of the Vanguard ETFs compared to the low but slightly higher expense ratio of AVGE. So can you take the Vanguard funds to replicate the AVGE?
Yeah, actually, okay, I hate to argue with you, but
You're going to get an argument if you say you can.
If I what?
If you say that you can take those Vanguard funds and replicate the AVGE.
No. But you can, using VT and VBR, get a facsimile.
Yeah, but they're managed differently.
Well, I'm not talking about from a management. I'm just talking about a portfolio that is going to be that's going to focus on small and value a little more heavily than a VT does.
Okay,
and
fair
that's
enough.
really the primary big advantage of AVGE. The primary is the overweighting towards small and value.
That's correct.
So you get a semblance of that. No, will it be exact? Because Avantis has a whole bunch of other rules in place.
Correct.
About the kinds of stocks that they will allow in a portfolio, whereas Vanguard's portfolios, VBR, VT, VTI, are slavishly using the index. They do not follow indexes at Avantis.
Yeah. They're just different. It's a different way to manage money.
But what I'm saying is, I wouldn't add VTI in because
I wouldn't
think,
do this. Because what the
saying,
real question Mitch is asking is, does it make sense to build this portfolio? And by the way, I would never only be 15% international because that's a way underweight.
Oh, that's so far. And again, and that's showing our bias,
home bias. Yeah.
Yeah. It's like, well, America's better.
But the reason he wants to do this is he likes the cheaper funds at Vanguard and thinks that's I would argue that in the long haul, paying a little bit more should supply a greater return in this case.
Okay, let's
because of the type of stocks.
Let's flip your verbiage a little bit. It has.
Right. You're right. What the future looks like, nobody knows. We're learning that now, but
we're not. And this is one of the points we're trying to make regularly when we get in. It used to be when we started doing this a couple of decades ago, there were some huge differentiators between funds, including DFA. DFA funds were a lot more expensive. This was pre-Avantis, than Vanguard's index funds. So there was a bigger fee hurdle to overcome. But with the advent of ETFs, the competitive landscape has tightened dramatically. The spreads between the cheapest and the slightly more expensive passivistic ETFs is small. Anyway,
that's fair. I think that's right.
Did you think you were going to look into my? Are you looking into my studio from your screen? Is like
making sure you're still awake there. Here's what I would do if I was trying to sort of split the baby here. I would own AVGE exactly, and then DFAW. There's a little bit of difference between the way those two are. A little. But that's how I would do it. It's still going to be more expensive than the aforementioned Vanguard index funds. So, yeah.
Yeah, okay.
All right.
But I'm saying you can get close.
Yeah.
If you're not looking to emulate, then you can get close, but you won't get it exactly.
No, you won't. All right. John writes us from Mechanicsburg, Pennsylvania. Don't know the place.
What? You don't know Mechanicsburg?
I do not.
Come on. You don't know your Civil War history. Go ahead.
What happened there in the Civil War? I don't know that.
Yeah,
Mechanicsburg?
Mechanicsburg.
I do know Civil War a bit.
Yeah, no, in Mechanicsburg, I believe Lee came.
Really?
Or somebody came in there during the war trying to bring it.
All right, well, while you're digging that out, I'll go ahead and ask the question. He says, hi, Tom and Don. Thank you very much for what you do. You're a regular listener on my daily commutes alongside Clark Howard. Hey, thank you for that. 48 years old, married, Army officer with 2 kids, 5 and 8 years old. My 3 most important financial goals are, number 1, children's college, which is a 2036 enrollment. Number 2, buy a home after retirement, which is coming in 2029, and saving for final retirement. I'll retire from the military in 2028 with the rank of colonel. Thank you, John, for your service. That's awesome.
Oh, full bird.
Yeah, I read this recently because I was doing some work on my dad's stuff. It's only 2% of the officers become colonels. So that's a small number. So well done. Small club. Annual pension will be about $130,000. Plan to work until full retirement age and take Social Security as late as possible. Wait for 8, John. That's well done. Although altogether, $1.6 million in investment assets, about $200,000 in home equity, and $25,000 on hand cash. Then he goes into the breakdown.
Okay,
$630,000 in a Roth IRA, which is in the S&P 500 index for $550 of it. I don't know how far we want to go into this, but he also owns things like the $24,000 in the AI index.
AI index?
BOTZ, he says, is the ticker.
AI, artificial intelligence.
Yes. Oh, I don't know what you were thinking.
Oh, I was trying. I thought it was the name of a company.
Pardon me. Out of nowhere. How would you know? 34,000 in the FBTC. I like the last 2 initials. 20K in the AVGE. Oh, he goes through a few of these tickers. As emergency fund in a target date index fund. I don't really like a emergency fund in a target date fund.
No.
510,000 in a Roth TSP with the 2040 target date fund, 180 and 529 plans. That's a lot of money for the kids, and $155,000 in a separate brokerage account, S&P 500 index. Most of my savings are through automatic deductions. This is something I've just spent a lot of time. Make it automatic. Wants to know what holes are in the swing and how do I work on them? Well,
I got.
Well, let me take one first.
All right, go ahead.
Well, first of all, the priorities. I think you got them backwards. College education, great. Buy a home, great. Saving for final retirement. I think final retirement should be first.
Yep.
That's got to be paramount because everything else follows.
Yes, but if he's retiring as a full bird, Colonel.
Yeah, he gets $130K a year in pension.
It becomes a lot in his position. Saving for retirement becomes less critical.
Absolutely, because you've got the pension and Social Security.
Yeah, so that can kick up like the house. That could kick it up a couple of notches.
But I
put the kids' college last. Generally speaking,
totally agree.
Because they can get money if you don't have enough for them. But it sounds like he's in a pretty good position.
But
right
the
now.
Asset allocation, Colonel,
it's a
needs
mess.
work. It really does. I mean, I guess not a colonel yet, but here's the thing: you've got.
Well, he's probably a light colonel.
That's a good point. He got most of this in the S&P. And then the other stuff you got is these weirdo.
That's what I wanted to go to. I want to go to those. Here's what you need to decide out of your entire wealth of your investments in cash. How much of that you would not mind taking to Vegas and potentially losing in its entirety? How much of that would you do?
I'll bet it's none.
I bet it's none, but if it's a couple of $1,000, that's how much you should have in the AI fund or the Fidelity Wise Origin Bitcoin fund.
I was wondering what that was. BTC. I had a pretty good feeling.
It's
something like that.
Bitcoin fund.
You got to get rid of all that stuff. It's all in your Roth. There's no reason to mess. You can sell it all tomorrow. There's no reason to mess around.
And the
reason, no international.
Yeah.
No small. Really.
No international, no small. No, he's got the S&P 500. He has no small. Yeah, except maybe in the AI fund.
Well, that's true, but not by intention. That'd just be by accident.
And by the way, 100% of his FBTC, 100% of the money in that portfolio is invested in Bitcoin. That's it.
Which is just, as you said, total gamble.
It's not an investment.
I don't like the $82,000 in your emergency fund in the Schwab 2025 target date fund.
No, that should be in a high yield savings or a brokerage money market account of some money market mutual fund. That should not be in a target date. Target date funds can fluctuate.
I mean, here's an easy way to fix it. Clean up your Roth IRA. First of all, get rid of the silly stuff you've got in there. And maybe you could still stick with 550 of the 629 in the S&P 500. Maybe because you could put the other part. You have no bonds either, other than what you've got in the target date 2036 fund, which I guess is okay. Let's go back because he has 510, 550 in the S&P. Maybe that's okay, but then you could buy an international index fund with the rest of it. But then get to the TSP. He has the Roth TSP in the 2040 target date fund. So that suggests you're probably in a 75-25. 70-30. Yeah. I don't want you to have any bonds in a Roth. It doesn't make sense. You got no small here. Okay, we're diving into the deep end. We got to start the shallow part.
But here's the thing. But the problem is he really doesn't have any place else to keep that stability, the bonds. He doesn't want them in his taxable account.
Nope.
So he's really out of places. He's got a lot of Roth going on.
Yeah, which is great.
No, it's great. But what I'm saying, he's almost going to have some bonds in a Roth.
Good point. And by the way, if I was owning bonds and I was in the TSP, I would use them there because they have that great bond fund that you and I cannot own. It's only available for government employees. So here, going back, I would take the 1.6 and say, okay, what am I trying to do with this money that I've saved? How much of it is, what rate of return do I need? What rate of return do I want?
Thank you. There,
and
that
then
is
go
the
back.
Beginning of the process. We're flipping it.
We screwed up. We picked on you a little bit for owning Bitcoin and
that's
AI.
Only because that's because they shocked both of us.
It's easy to do. So I would go back and I'd say, okay, I'm going to be just for sake of argument, because I'm 48, 70% in stocks, 30% in bonds. Okay. As Don then said, where am I going to own the bonds? How am I going to do that? I probably would own them in the TSP because they have a very fine bond fund. Then I would go back to your Roth IRA and rebuild that, but I would rebuild it with all the principles that we've tried to talk. You got to have large. You got way too much. You got to have some small. You got to have some value. You got to have international. I'd rebuild all of that with that in mind. That's probably the fix.
And for his response, but here's the response. Yeah, but that S&P 500 fund has done so well. Congratulations, you got lucky.
Yeah,
you got lucky. You hit one of those times when the S&P 500 type of stocks destroyed everything else on the market.
Sure.
That is not always going to be the case.
Yeah.
Well, so it hasn't always been the case.
This is a big fix. So this is going to take some time, Colonel, and you need to dive into it.
Good news is most of it's in non-taxable, though.
Exactly.
So.
No, you can sell everything. You can do it tomorrow. So, but I would go back, as I say, and work the plan first. So, all right. This comes from Michael in Sterling Heights, Michigan. Hi, Tom and Don. Semi-retired, work with a young man who just got his first real job. Pays $65,000 with full benefits. He's 26. Owes $5,000 on credit cards and $3,000 in student debt. He's got a 403B at his city government job. He also got a separate Roth IRA, making some good steady money. Want to give him some advice on what order he should work on to get rid of debt. Should he stop investing and pay off debts first? Thank you for any general help you can provide.
Let's do it for the whole world. There is a debt hierarchy. The debt that you don't need to bother with right off the bat is typically mortgage debt. Mortgage debt is, for most people, not gonna hurt you much, and your investments, particularly aggressive investments, could outperform a mortgage. So, and a low interest mortgage, I wouldn't touch at all. Anything double digit. If you have double digit debt in your portfolio,
which is likely to be the credit cards.
Yeah. You have double digit debt, then any savings that isn't matched by someone.
Look at you. That's the part I was going to get to.
Yeah. Free money. You got to take the free money.
Indeed. So you would be saving up to at least that amount from day one. Then you would build the pay down on the credit card debt. Then you would go after the student loan debt, which is no doubt a lower interest rate. But you make a very good point. Then I'd probably, after that, then I would get into the Roth IRA. Yeah. That would be my order.
And by the way, I forgot to mention the Mechanicsburg thing. It was I believe the northernmost city occupied by the Confederates. They came up into Pennsylvania for a little while and occupied Mechanicsburg. It wasn't Lee, but it was one of his generals.
So Mechanicsburg was in there somewhere. I don't know. I didn't know that. That's limited battle.
It was occupied.
Okay. All right. Fair enough. Let's see. We've got a couple more here, so we've got to hustle. So Carrie writes us from Olympia, Washington, just down the road. Hi, Tom and Don. Good point. I have a 403B from an old employer. Stopped working there in 2018. Sitting with Fidelity, an orphaned plan, as I call them. I've done nothing with it because I don't know what to do. I'm now thinking roll it into an IRA, still keeping with Fidelity, but open to suggestions. I'm just learning about investing, so I don't know much, and the simpler, the better. There's $70,000 in the account, and it's invested in target date funds. I'm 43, make about $85,000 annual, plan on working at least another 20 years, unless I somehow do really well and stop earlier. That's good. I anticipate moving into the next tax bracket in the next couple of years, moving from 22 to 24. Does this sound like a good idea? Is there any advantage to having both a traditional and Roth? Because he had talked about maybe moving it to a Roth and paying the tax. Okay, so old employer plan. First of all, I love the way you just answered that previous. Stepping back, I personally think you should have one pre-tax account, one Roth account, and one taxable account. When you start having more of these accounts, you forget about them. It's confusing. Work. Yeah, you got to pay attention to it. So, but here's my question to you, Carrie. Does it make more sense to take the old employer plan and put it into your current plan rather than putting it into an IRA? Because here's the disadvantages with an IRA. First, if you ever want to if your income goes up to the place where, and it's not there now, but if you get to the place where you cannot do a Roth IRA, You will not be. It'll be very difficult to do a backdoor IRA, a Roth IRA, because you'll have to do the pro rata amount.
Yeah.
It gets more confusing. So I would probably first look at the options in the new plan to see if they're reasonably priced and well diversified. If they were, I'd probably take the old plan, move it into the new plan.
Yeah, I think that's probably a good plan.
If not, then yes, you can put it into it.
If you've got good choices in the new plan, yeah.
Yeah, or you, as you say, you can just move it to Fidelity, keep it in an IRA there. And he does ask about the advantages of both traditional and Roth. Yeah, at 43, I would want to be saving in both places. Absolutely. Because it's going to build that bucket, if you will, of post-tax money that in the 20 years from now, could provide income with no income tax, which is huge advantage for people.
See, look at that. Tom did that one all by himself.
And you agreed with me? That never happens.
What's wrong with me?
You didn't
Quick,
take
get
your pill this morning.
Hurry,
All right.
hurry.
All right, here we go. Tim from St. Louis, Missouri.
Yes, not Tim the Enchanter, just Tim.
The Enchanter? I heard a podcast that dimensional funds beat the benchmark. I'm trying to figure out what I'm missing. Morningstar, DFAW, 13,222, and the index, 13,509. What am I missing?
See, the index isn't the benchmark.
Well, not for DFAW. There is really no benchmark per se.
There is. It's a global portfolio, but it's a global portfolio. Let me see what they use as the benchmark. I want to go to Morningstar and see what they're using as the benchmark. So we're talking DFAW, right?
Yep. That's the Dimensional
World Equity ETF.
Correct.
And when we look at
I don't even know how far back you can go with the DFAW.
You can't go very far with DFAW because DFAW didn't open until 2023.
They did have the mutual fund, the Global Mutual Fund.
Yes, in 2024, they did beat their category, and the category is Morningstar's Global Total Market Equity. It's their own benchmark.
Ah, okay.
Because it's global blend. Okay? This is global blend, not global. If you look at an index, it tends to be global large cap and growth. So this is global large blend. That's their category. And they beat their benchmark by 2 percentage points in 2024.
But I will tell you this.
However, year to date, they're underperforming their benchmark.
And that's going to happen in short periods of time. Here's the thing you need to decide. Every investor needs to decide. Is it okay to invest primarily in large U.S. companies, or should I spread that out to international? You are buying some international here with the index, I guess. But do I think that smaller, value-oriented companies, other factors will play a role in creating greater returns in the future? Don't know for sure, but for me, yes. So I'm going to invest that way. But you may just say, take the index and I'm fine with it.
Well, let me just kind of compare the two. The global large stock blend category, which is the thing to which they're comparing. That's the category. That is very large companies, very large, and the portfolio skews slightly toward growth. The DFAW, while it's still in aggregate more large than small, just because of because of market cap, skews a lot smaller in terms of overall size and a lot more value-y. But it still emphasizes large company stocks. I mean,
you end up owning them.
Yeah. It's a fund of funds, by the way, too.
Correct.
It's the Dimensional U.S. Core Equity, International Core Equity, U.S. Core Equity 1 and 2, Emerging Markets, and Global Real Estate. So you get a much more diverse portfolio. Much, much more diverse.
And I want to be more diversified. We don't know which part of the markets will provide greater returns. We do know that looking past that, doing it that way has been better for returns and also reduce volatility a little bit because not everything goes up and down together. So I prefer that approach.
Right. And technically, it is considered a riskier portfolio.
Yep.
Because you have more small and more value, which tend to be in and of themselves more volatile. However, the reason you have in the past gotten a slightly better standard deviation is because they don't necessarily zig and zag at the same time. There may be a little zig here and the other one's zagging a little bit more.
Yeah, fair enough. All right. I want to mention before we get thrown out of this studio, which I just rent. How long? Oh, we still got a couple more minutes. They said, I'm coming to the Southwest because, after a while.
You know why he's coming to the Southwest?
Because I miss all of you.
Yeah, that's not it.
That. No,
it's flipping cold in Seattle, and he's sick of it. So he needs a break, and he's going to Phoenix.
That's true. And I want to meet you while I'm in Phoenix.
So he can write it off.
I don't even expense any of this stuff. I probably should, but I don't.
You should expense some of it.
I know. That's dumb. Okay. So Monday.
Jim's listening to this going, no, don't expect it.
Don't do it. Monday, April 14th, I'm going to take one-on-one meetings with our Uber advisor, Claire Thornton. Wow,
wait, we have an advisor who has to drive an Uber because she doesn't make enough money?
She does it on weekends. It's okay. Just to meet people.
Sure. That's a great way to prospect.
Exactly. So,
hi, Uber passenger. Do you have any money? If I had any money, would I be in the back of your Uber?
Ooh, it smells. Listen, here's the...
Oh, you're saying her Uber smells? This is not going to work well for you this trip.
Okay. Monday, April 14th, I'm going to take one day out of the sun and meet with folks like you. We did this in Madison. We've done it in other places, and people love it. So if you want to have a meeting with Tom on Monday, April 14th, and you live in the greater Phoenix area, then all you do is go to talkingrealmoney.com and click on Meet an Advisor. Say, I want to meet Tom in Phoenix that day, because it will go fast. We're only doing
and put in your address so that our advisor/Uber driver can pick you up.
That's right. The beeping will anyway. So Monday, April 14th, take advantage of that. And by the way, our advisors now have time again. So you can meet an advisor as well if you don't want to come to meet me in Phoenix. How about that? We haven't promoted that in a long, long time.
No, we haven't, because we've been so busy.
So we're opening things up
go
again.
Go to talkingrealmoney.com, click on Meet an Advisor. That's the way to do all of that. And
I hope to see you in the sun.
Yeah, whatever.
Okay.
You know what? That's where you all escape to, too.
I know.
Because you're wet and cold, so you go, dry, warm.
Yeah.
Give me
and
dry,
it's
warm.
Close. It's like 2.5 hours away. You got to love it.
Yeah. Where I'm in warm, wet. Well, no, it's not wet yet.
It's coming.
Yeah. Anyway, thanks for being there. And please stop in almost every single day on this little podcast service where we will be, well, as long as we're still here, taking breaths, talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.